Imagine you lock your savings into a 5-year deposit at 1%. A year later, rates jump to 4. Your money is now trapped, earning 1 while the rest of the world earns 4. A bank can make that exact mistake, just with billions on the line. And the whole industry has a name for it. It is called IRRBB, interest rate risk in the banking book. So what is it? And why do regulators now stress test every bank for it? So let me break this down from first principles. Why does a bank care so much about interest rates? It comes down to one root question. When rates move, who wins and who loses on the bank's own balance sheet? A bank is really just a giant machine for borrowing money short-term and lending it out long-term. And that single mismatch is where all the danger hides. Here is the mismatch in plain terms. Your deposits can leave or reprice almost overnight, so the bank's funding cost follows today's rates fast. But the mortgage it gave you is fixed for years. When rates rise, the bank has to pay more for its funding almost immediately, while it is still stuck earning the old low rate on those long loans. The margin gets squeezed from both sides. There is a hidden lever that decides how bad this gets, and it is called duration. Duration is roughly how long until a loan or bond pays you back. And the longer it is, the more its value drops when rates rise. A long-dated, low-coupon bond can have a duration near 20 years. That means a 2% jump in rates wipes out roughly a third of its market value. And in 2022, rates moved far more than that. Because this risk can hurt in two different ways, regulators make banks measure it twice. One view asks what the damage is to the bank's underlying worth today. The other asks what it does to next year's profit. They have names, EVE and NII. They sound technical, but the idea behind each is simple. The first view is economic value of equity, or EVE. Picture marking every loan, bond, and deposit to today's interest rates, then asking what is left over for the shareholders. It is the whole building view. If rising rates have gutted the value of those long, fixed-rate assets, EVE shows the loss exists right now, even if the bank still looks profitable on paper. The second view is net interest income, or NII. This one is simpler, how much the bank's interest profit changes over the next year or so. If EVE says the whole building is on fire, NII tells you when the smoke actually reaches the rooms. The economic hit can sit hidden for a while, then show up as a brutal drop in earnings once cheap funding has to be replaced at high rates. This is not just theory. Silicon Valley Bank held about $91 billion of long-dated bonds, bought when rates were near zero. When rates shot up in 2022, those bonds lost around $15 billion in value, almost the bank's entire equity. The accounting let it hide that loss until depositors got nervous and pulled their money. To pay them back, the bank had to sell those bonds and crystallize the loss. It failed in March 2023. No bad loans, no fraud, just pure interest rate risk. After episodes like that, supervisors do not just trust a bank's own comfort. In Europe, the EBA makes a bank run its balance sheet through 6 standard rate shocks, like rates parallel up, parallel down, or the curve twisting. If the value loss tops 15% of core capital, or the earnings hit tops 5%, the bank trips the Supervisory Outlier Test, and the regulator starts asking hard questions. A sister rule, CSRBB, covers a related danger: credit spreads widening rather than rates moving. Now here is where it gets genuinely hard, and where modern tools come in. The single trickiest input is everyday deposits. Legally, customers can pull that money tomorrow. In reality, most of it sits for years. So a bank has to estimate a behavioral life for deposits that have no fixed maturity. And in Europe, the average assumption is capped at around 5 years. Guess that wrong, and every EVE and NII number built on top of it is wrong too. And this is exactly where AI walks in. Instead of a crude moving average, machine learning models can predict how sticky each pocket of deposits really is, and how fast it would flee if rates jumped. AI can also rerun those 6 shocks, and far nastier ones, across the whole balance sheet in minutes, and it can watch deposit behavior in near real time. The early warning Silicon Valley Bank never had. It would not have guaranteed a save, but a quarterly snapshot clearly was not enough. But a sharper AI model is not a free pass. The moment it feeds a regulatory number, it falls under the same model risk rules as everything else. It has to be explainable, independently validated, and owned by a named human, never a black box. The bank can let AI do the heavy lifting on the maths. It just cannot let AI be the one who signs. So here's the whole of IRRBB in one line. It is the risk a bank takes by borrowing short and lending long, measured as a hit to its value and to its earnings. Get the deposits and the duration right, and you ride out the next rate shock. Get them wrong, and you become the cautionary tale. I have put a one-page IRRBB checklist in the newsletter, the exact questions to ask about duration, deposits, and the outlier test. Link below. Subscribe, and I will see you in the next brief.